Welcome back to Investing Talk Podcast.
Today we're looking at ASML.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When you really look at the tech sector, there are only a handful of companies that are truly indispensable.
And ASML is right at the top of that list, isn't it?
Arguably, yeah. What we want to do today is really unpack how their competitive edge translates into financial strength, and whether the real risks, are being handled.
Right. And for anyone who's maybe not as familiar, ASML is, well, it's the definition of a critical supplier. They build these incredibly complex machines, these lithography tools that companies like TSMC, Samsung, and Intel need to print circuits onto chips. They're the ultimate bottleneck.
That's the perfect word for it. And that bottleneck is what creates this almost unassailable moat around their business. It's not built on marketing. It's built on pure technological IP and just the mind-boggling complexity of what they do.
Especially with EUV, right? Extreme ultraviolet lithography.
Yeah, exactly.
I mean, when we say that, we need to make it real for people. What kind of precision are we actually talking about? Because the physics involved are just, they're wild.
They're almost unbelievable. So, to give you some context, these machines are printing features on a chip that are measured in nanometers.
Okay.
If you scaled that chip up to the size of planet Earth, the lines ASML's machines are printing would be just a few inches wide.
Wow. That's the level of engineering we're dealing with.
That's the mastery. And because of that, they basically have a complete monopoly on the most advanced chips.
A monopoly?
Yeah. We're talking a dominant market share, consistently over 90% in these advanced systems. Nobody else is even in the same ballpark.
Okay, so this is where it gets really interesting for an investor, right? It's not just that they're the best today. It's how they make sure no one can ever catch up. The switching costs must be enormous.
That's the structural lock-in. A chip fab. A multi-billion-dollar factory. Its entire layout is optimized for ASML's systems.
The whole process.
The entire process flow.
Yeah.
Everything is calibrated to their machines. So switching isn't just swapping out one tool. It would mean redesigning the entire factory. It's financially catastrophic.
It's economically irrational.
Completely. And then you have the time gap. Even if a competitor had unlimited money right now, they'd still need, 5 to 7 years just to develop a competing system? And by then, ASML is already on to the next thing.
Which is high NA EUV.
Exactly. They're not standing still. They're already building the next generation, which is another huge technical leap.
Yeah.
It basically guarantees their moat extends deep into the 2030s.
So the billions they're spending on R&D today is just buying them more guaranteed lead time?
Precisely. And, speaking of reinforcing that moat, we have to talk about geopolitics. Because, funnily enough, the export controls, especially on China, they actually help ASML.
Okay, that sounds counterintuitive. How does preventing sales to a huge market actually help them?
Well, it constrains the competition. For a competitor to even try to catch up, they would need massive, massive scale to fund the R&D.
Okay.
By limiting access to a major market like China, these rules basically stop competitors from getting the scale they need to close that technology gap. It cements the monopoly for the rest of the world.
That's a vital piece of context. And that dominance has to show up in the financials. I mean, the pricing power must be incredible.
It absolutely is. Let's pivot to that. The first half of 2025 was very strong. Q2 net sales hit, $7.7 billion? So strong growth, confirming demand is accelerating.
For me, though, the most incredible metric is the backlog. It just stays so high. In this industry, having 12 to 18 months of revenue already locked in, that is just phenomenal. It removes so much of that cyclical risk.
And what's really fascinating is how they maintain profitability through all of this. They held their gross margin guidance for 2025 in a range of 48 to 50%.
Okay, let's just pause on that number. 48 to 50% gross margin. In the capital equipment world, that is. That's not typical.
Not at all. I mean, many of their peers are in the low 40s, maybe high 30s.
So what does that spread really tell us?
It tells you they have absolute pricing discipline. They can absorb inflation, higher component costs, and just pass it all on to the customer. It's the kind of margin you'd expect from a software company, not a giant industrial manufacturer.
And that pricing power lets them run a fortress balance sheet, generating all this free cash flow.
And they use that cash for two critical things. First, innovation. They're pouring about €1 billion a quarter in R&D.
$1 billion a quarter. Wow.
That's what fuels that high NA race we were talking about. And second, aggressive returns to shareholders.
Which is such a strong signal of confidence from management, right? They're not just sitting on the cash, they're actively buying back their own stock.
It's a clear signal that the people inside the company think the market still undervalues their long-term position.
And the fuel for all this, of course, is the massive tailwind from AI. We're really talking about ASML as the indispensable infrastructure for this entire era.
That's exactly the right way to frame it. You simply cannot build the advanced chips that power the AI boom, the GPUs, the custom silicon. Without their machines, they're the gatekeepers.
And management isn't shy about this, are they? What are they projecting?
Their confidence is extremely high. They're not just projecting growth for 2025. The key takeaway is they are explicitly preparing for growth acceleration in 2026. They believe AI demand is going to drive an even steeper curve in orders next year.
Now, let me just push back on that a little. That's what everyone is hoping for, but isn't it possible that AI models get more efficient? Smaller, better optimized, requiring fewer hardware upgrades. Could that demand curve flatten out faster than they expect?
That's a valid question. But their confidence comes from visibility into what the big foundries are planning. Even if models get more efficient, the cutting-edge stuff, the next generation of AI will always require the most advanced chips.
And only SML can enable that.
Only ASML. So their view is that they'll capture a disproportionately high share of that capital spending no matter what.
And that's what institutional investors are banking on.
Exactly. And you can see it in how the stock trades.
How so?
Well, you're not seeing distribution, you're seeing accumulation. The stock is consolidating at these higher levels, which is a very bullish sign. It means the big long-term money sees any small dip as a buying opportunity.
So they're not trading it for one quarter's earnings. They're buying it for the next decade of AI.
Absolutely. It's a core AI infrastructure play. If you believe in that long-term story, you basically have to own the one company that makes it all possible.
Okay, so a very strong case. But every thesis needs to be tested. We have to drill down on the bear case. What's the number one risk here?
It's still geopolitics. The export controls on China. It's a constant balancing act for them, and if those restrictions tighten further, it could limit their total addressable market.
And that would squeeze the growth projections, wouldn't it?
It would limit the upside, yes. But the mitigation is that their biggest customers for the most advanced machines, TSMC, Samsung, they're not in restricted markets. So that huge backlog gives them a very stable revenue base, even with China-related headwinds.
Okay, so that's the regulatory risk. What about the classic industry risk? The cycle.
That's risk number 2, an AI CapEx cycle slowdown. If the hyperscalers suddenly pulled back on spending, the equipment orders would drop, and that would put a lot of pressure on that 2026 guidance.
The classic demand cliff.
It is.
Yeah.
But again, you have strong mitigations. First, that 12 to 18-month backlog acts as a huge cushion.
Right.
And second, management's view is that we're still in the earlier middle innings of this AI build-out. This isn't a mature cycle about to peak. It's a long-term investment cycle just getting started.
So investors really need to watch that 2026 guidance like a hawk. And the next big catalyst for that is?
It'll be the Q4 2025 earnings report, which will probably come out in January 2026. That's when we'll get the first official guidance for the full year. It's going to be pivotal.
So if we bring this all together, what's the summary here?
You're really combining 3 things. 1, fortress-like fundamentals with those incredible margins. 2, an unmatched technological moat that looks secure for a decade. And 3, this powerful multi-year AI tailwind.
Yeah.
It's just a uniquely positioned company.
The gatekeepers to the future, as you said.
I think so. It's a powerful compounding vehicle for anyone focused on the AI infrastructure build-out.
Fantastic analysis. Before we sign off, remember to subscribe to the show for more expert analysis like this.
Okay.
We spent a lot of time on their ability to maintain those incredible gross margins. And that leads to a final thought for you to consider. If input costs and supply chain problems keep getting worse globally, how long can ASML really maintain that 48 to 50% margin? The answer to that question, quarter after quarter, is the real test of their pricing power moving forward.
A great question for listeners to track.
Thank you for tuning in to Investing Talk Podcast. We'll catch you on the next one.